Well, good morning. We're up to day 2 on pensions. This is chapter 17. We're going to be continuing with it. Our final problem we worked was kind of an introduction to this section, because this section is going to be about the walk forwards, and there's several approaches. Within the module, I gave you both a photo, which is what you also see within your packet, which shows how pension expense changes, how the PBO changes, and how plan assets change. And then also, David O'Brien created an Excel spreadsheet, which is included. And some of you who like Excel may like to look at that. It also explains in better detail what happens with OCI and how OCI changes. So both are quite appropriate to use. I find on the CPA exam, a lot of the questions on the CPA exam are questions which are related to the walk forward and the process of doing a walk forward. We have had a few changes in the way in which we record pension expense recently, but I would say this area has really not changed very much in probably the past 5 years. So what you learned today, I expect will carry forward until when you take the CPA exam. There are two primary plans available for the employees now. Those are the defined contribution plans and the defined benefit plans. And when we are talking about defined benefit plans, we have to start thinking about the PBO and working through those. I realize the slide says defined contribution. It should say defined benefit there under 1, part 2. The PBO is that present value calculation. We did it for an employee, but actually we have to recognize that that's not the appropriate way to do it, because we have too many employees for us to actually do that. So the actuary is going to be doing it for our whole group of employees, those that are eligible for retirement plans. We have service cost and interest cost, and while we calculate the interest cost on the PBO, you need to be sure and not call it interest expense. And we would not be calling it interest expense because it is not related to a liability of the company. It is a liability which exists within the pension plan, and you have to think of the pension plan as separate from the company. So what are plan assets and how do these change, and understanding pension expense, and then the separate income statement classification for service costs, because we call it a pension expense, and I'm going to continue calling it pension expense, but as a service cost, it really is related to the compensation that the employee is receiving. We have under 5 the corridor method. It's one of those things that you do, and the corridor method is an approach to managing the amount that you have in OCI. So to explain it in the shortcut way, I would say we put things in pension expense that hit the income statement. However, we recognize some things should not really be showing up in earnings of a company. They should be showing up somewhere else, and that somewhere else is called OCI. The things that hit the income statement are the things that management is responsible for, the things that the company's decision making causes them to incur, or the good things such as revenues that happen as a result of the decision making of the company. The thinking here is that some things are beyond the control of the company. Those things beyond the control of the company, say from macroeconomic events, should be in another classification. So let's call it other comprehensive income. Well, the problem here is if we get too much in OCI, the OCI is closed into AOCI, accumulated other comprehensive income. So we have a big equity item, AOCI, that can keep growing and growing and growing, so let's manage it. That's the corridor method. Taking things out of AOCI, putting them back in pension expense, putting them back in the income statement. So what we're really doing is trying to manage two things. We're trying to manage our income statement. It can get out of control. And we're also trying to manage the equity section, which is the AOCI. It can get too big. So let's manage, and that is the corridor method. I'd say the corridor method is very arbitrary. We come up with numbers, we come up with calculations, rather arbitrary, but it's done consistently. And as it's done consistently, then in the end, we come up with a manageable value in AOCI and in our income statement. That's a brief overview of our objectives for this. And as I said before, really we're going to be starting when we start working on our packet. We'll start to work from where we left off and go forward. Plan assets are the investments of the plan. They include cash as well. They are valued at fair value. So they accumulate from return on investments. If new contributions come in, these new contributions technically come into plan assets cash. And then as we take our plan assets cash and invest it, it becomes plan asset investments. So the point I would make here is that as long as you have cash in your plan, if you were to take that cash in your plan and invest it, there would be no change in plan assets. There would be a change in the composition of plan assets, because now a part of the plan assets that was cash is now going to be investments. Still, it's plan assets. And the plan assets will then go down as a result of benefits being paid out to retirees. And those of you who are astute about this will say, yeah, when the plan assets go down from paying out, what also happens to the liability? And the liability is going to go down. So you are going to be calculating the value of plan assets at balance sheet dates and recording or determining whether you have gains or losses when you do that. So here we have an example of a walk forward. We have a plan assets beginning. You're to assume that's January 1st is the beginning. And plan assets at the end, and that's the end of the year, December 31st. So we start at 70, we need to be at 105. If we pay benefits out, that's going to reduce. And if we make contributions to the plan, putting more into the plan, that's going to increase plan assets. So somehow you're going to have to start at 70 and end up at 105, and you have to figure out what the difference is there. And the primary reason that it's going to go up is going to be because of a return that is earned on plan assets. We would want this to be a positive adjustment to get from our beginning to our ending balance, because we would like for our plan assets to earn a return. Trustees doing a good job if it earns a return. So the actual return on plan assets is a plug number there, and it's 10. Now this is the actual return. So we have to also think about what we expected the return to be. And the expected return may not be 10 million. We might have expected to earn 9 million, in which case we did better than our long-term goal because we have 1 million over that. That overage, or if we were, say, to underperform here, maybe we expected 12 million and we actually got 10, that underage of 2. Those overages or underages, where we had a goal and we either made more or we made less, those amounts do not go to pension expense. those amounts need to go to OCI. So this is a concept we'll return to. However, when we're doing a walk forward, what matters? What matters, since we're using fair value accounting, is the actual return. Now that return can be a cash return. It could also be a return which is just from the change in the fair value of an investment. It really doesn't matter. It is just a change in plan assets that's because the plan assets have earned a return. Here we have another one. We have plan assets beginning and end, and they give us a return. And they're going to ask us what the employer contributions are. So as you work through this one, you should be able to come about and do this calculation. It's saying what goes in there so that at the end I end up with 525. The way I usually approach this, I say 350 plus 50 is 400. 400 minus 85, right, gives us a number. How do we get from that number to 525? And that's the way I work through these problems. Those of you who loved algebra can also think of this as an algebra equation and you're solving for x. Whatever floats your boat in solving these. They are simple walk forward problems. They show up a lot on the CPA exam. Plan assets change. Here we have cash of $48 million contributed to a pension fund. Plan assets at the beginning, they tell us an expected return and they tell us an actual return. So here's where we're going to start talking about the amount of change in plan assets that goes to OCI and the amount of change in plan assets that is for pension expense. They expected 9 and they got 10. So this change is a good change. I also should tell you at this point that when we're talking about return, generally you're thinking of that as a revenue item, are you not? However, we have no real revenue items when we're talking about pension plans. Instead, we say it's a negative pension expense. Or you could say it this way, it's a credit to pension expense. This runs counter to the way we like to think, but that's what we're going to do when we start talking about pension expense. So this is the way we go forward, and here when we work through this one, the actual return on plan assets, just like PBO interest expense, right? Interest cost, which we call pension expense. I clarify my terminology here. You calculate it on the beginning balance. So the actual return, if it says 10%, is going to be 10% of the beginning balance. Now, the astute of you out there are going to say, but 1% of it is from something that we did not expect, and therefore 1% of the 300, when you did a journal entry, that 1% technically needs to go to OCI. Gains and losses really arise from two accounts. There are the PBO, changes in our liability. These come from the actuarial changes that we really cannot control. That's the primary change that you might see there. And plan asset accounts are going to change also. And this is the difference between the actual and expected. We are going to call these the gains and losses, and these type of gains and losses are going to end up in the OCI. Here we have a company, then Brendan Health Services, that had a net loss in AOCI in last year's balance sheet. This year they revise their estimate of salary levels, which is an actuarial change. It's an actuarial estimate, actuarial gains or losses in PBO, that cause our estimate in the PBO to decline by 24. If you decline or reduce a liability, I would say that's a gain, right? So that's a gain of 24, and the actual return on plan assets was less than 54. I would call that a loss, and it is actually a loss of 6. So what you're going to do on this thing is you're going to net these two things, and the net of the two things will cause a change in comprehensive income. So the solution to this one, if we were doing this in journal entries, we would say the 24 is going to go to OCI, and we would say that reduction in plan assets, a part of that would go to OCI, the 6, as a loss. So as I said before, you have a gain, you have a loss. Now, plan assets overall needs to go up by 48. So you're also, to make your plan assets right, you really need to look at plan assets and say, I just took it down by 6, and in the end, I need to take plan assets up by the actual of 48. So to do that, you are going to record in plan assets the expected return. So the next journal entry that's not up here yet would be an increase in plan assets by the actual, which is 54, and then a credit to pension expense for that 54. Overall, when you look at the plan assets, you're going to go going down by a bit and up by a bit, and the net of those two in plan assets is going to be the 48. And that's what we want, because that would make it walk forward. Now, pension expense, to talk about the components which go into pension expense. Pension expense, really, the way I look at pension expense is it is an income statement item. And when we look at this income statement item, we are going to put, of course, the interest cost, which is and up here it says interest accrued on the pension liability. That's the PBO balance times the effective rate. It's a discounting rate, you might call it that, so that the PBO increases from time value of money concepts. This is going to show up as a pension expense. It is a debit amount, right? And then you have service cost, and service cost, we went through individual examples on the PBO, and we said those were changes which were attributed to that individual having worked another year. These things are fairly standard and very, very large numbers, usually large amounts in terms of the PBO balance. The reduction here in pension expense, which we just covered, was return, which was earned on plan assets. Now this is the expected amount, because you have to divide the plan assets change in value from return into two things, expected and not expected. And the not expected goes to OCI. The expected goes to pension expense. And again, you would think of it as a return would be a revenue type item, but because when we do pension accounting, we don't have revenue items, we are going to call it a negative pension expense. So if you want debits and credits, it's credit. It's a credit to pension expense. And this is the return on plan assets that is the expected. Now, Down below, you say there are prior service costs attributed to employee service before an amendment to pension plans. And they're amortizing amounts. They're spreading amounts over periods of time. And then it says losses or gains from revisions or for investing in plan assets. I want you to be less concerned about these items. The concern you need to have here is to understand that when we do our corridor method, you may be putting more in to pension expense. It may show up in pension expense as a debit. It may show up in pension expense as a credit. But the other adjustment, which I really want you to be concerned with here, other than those top three, is the fact that we may also be putting items in pension expense because we are managing that OCI. Interest costs that go into pension expense are PBO balance at the beginning times a discount rate. And I give you the corollary to that. And we were talking about our liabilities, and we were saying interest expense, right, is based on the beginning balance. But we do not call it interest expense. We cannot do that here. We have these interest costs, and they show up as pension expense. Expected return on plan assets is something that you look at over the long term. And this is the proper way for the trustee to manage plan assets, because they are going to think about making investments, and yes, they have to have some cash available to pay off their retirees as each year passes. We have new groups of individuals that are going to have to be paid, but they need to think of it overall. And overall, what you're doing is you're putting something in, and in terms of investments, you're hoping that it earns so that in the future you have amounts that you can pay off. If you want to think of it as a foundation that you're putting money in and you're earning a return, and you're using the return to pay your retirees out of their retirement benefits. That's really the way you should be thinking of this for you finance majors. That's the way it's looked at. And when you think about this, then you're talking about a long-term return, a long-term return. So a gain or loss that you get amortized that comes into pension expense is either going to be a debit to pension expense or a credit to pension expense. And this is because we really have too much. The main reason is because you have too much happening in the OCI account. The AOCI is growing at too great a rate. So if you were to do one big journal entry with pensions, what you would be doing is you would be increasing your pension liability over time. You would be increasing your pension assets over time, and you would have then the net of it being a pension expense. And that's not quite right, because you would also have an OCI item that you would be recording, and that would be the difference between your actual and expected returns in your plan assets. And then you would also have an OCI item that is because the actuary comes back and says, hey, people are living longer, or hey, their ending salary is higher than we expected. That's an OCI item. It does not show up in pension expense because we do not want it to show up in the income statement, and because it's not really a management's decision. So if we have an example here that you might work through, it has a number of items at the top. We have a similar problem to this, which we're going to be working when we work at our packet. We have a beginning balance, we have an ending balance, We pay benefits, and if you pay benefits, then you know your liability or your PBO is going to go down. We have a discount rate, and the discount rate is called pension expense, not interest expense. And we have service costs, which increase the PBO. And then they say we need to recognize our prior service costs in our pension. And so this is an additional amount which we are going to put in there. I'm assuming this is the amortization of prior service costs. As I said before, I really don't want you to spend too much time on prior service cost and amortization of it. So here is your walk forward then, and your ending balance, if you did this walk forward, you find it should be $345,000, but we find when we go to the actuary that the actuary believes that our PBO obligation as of this balance sheet date, and they're doing the present value calculations just as we did with that one individual, only they're doing this for all the individuals. They come up with 400,000, and we have 345,000 in there. So we have to record a loss, and we are going to call it an actuarial loss because we need to increase our liability. So we have a loss of 55 that we will record. So you would take it again to OCI as a debit, and it's an actuarial loss, and you would be crediting your PBO to make your PBO balance go up by 55 because now we have an increased liability. Now, amortization of gains or losses on plan asset, what's all that about? Well, here we have a plan asset, beginning balance, ending balance. We make payments out of the plan. Now, these payments are going from the plan. They are just amounts that are leaving the plan. So therefore, you would see that as a reduction in the plan assets. The expected rate of return on the plan is 8%. That would be 8% of the beginning balance, and that is the $12,000, and that would be an increase. So when we work through this problem, if we work through and do a little walk forward, we have a balance of $157,000, but we actually, when we do our fair value and we go out and we look at our investments at the end of the year and we look at our cash, we do a fair value calculation on the investments. We do a value of cash, which is its fair value. We find we have a total of $170,000. So what the heck has happened here? Well, apparently we had an additional return that we hadn't planned on. And this is a wonderful thing to happen. It's an increase of $13,000. It is inappropriate to call this $13,000 a return to hit the income statement because it is not really an activity of the company that results in this. It's not something that really contributes to your thinking about how the company is performing. It's talking really about how the pension plan assets are performing. So let's call that OCI. This is a gain, an OCI gain. So again, you put an additional debit into plan assets, and this additional debit is for $13,000. So your OCI items from plan assets, they can show up as debits to OCI, or they can show up as credits to OCI, depending upon whether you make the expected return or you don't make the expected return. Now the other part up here, this expected earnings. The expected earnings is going to be a debit to plan assets, so we need a credit, don't we? And so the credit is to pension expense. Runs counter to all of our thinking to be crediting an expense, But again, we don't have a revenue item, so we put it in pension expense. This is a brief summary of everything that I have just talked about, and it's leading us up to the corridor method. And in the second square up here, the gain or loss needs to be taken care of. We don't take it directly to the income statement. Generally what happens is it goes into OCI, and if OCI gets out of control, then we take it to pension expense. Now, under the first bullet, it says you can take it directly to your income statement, but I'm going to tell you companies would not do this. Yes, it would be wonderful to have an additional boost to your income statement because the stock market is doing well and your plan asset value just went up a lot. But the problem with it is it makes your income statement out of control, and companies do not like to have an out of control income statement. Investors want to be able to predict changes in earnings, and they want in fact there are conference calls that say this is where we expect our income statement to be. So I'm going to say bullet 1 is usually not done. Second, the corridor method. That is the method most companies use. And the third one is a method that's very similar to the corridor method, and you have to actually prove that it accomplishes the same thing as the corridor method. So if you are a company and you had to choose between these 3 bullets, which one would you do? You would do 2, because 2, you can lay it out in front of you. You know precisely what effects it's going to have. And 3, you're always justifying it to the auditors. 1, you don't have income smoothing. You have radical changes in the income statement. So the corridor method is the thing I teach. The corridor method takes the asset or liability gains and losses to OCI. Then you amortize to pension expense. You have a minimum amount that has to be amortized. This is where it gets a little strange, very arbitrary. You look at the balance in PBO or plan assets, and this is the value of plan assets. You take the higher of each one of those balance, and you're going to say, well, one's a debit, one's a credit. Forget about that. Just take it times 10%, and then you say, is my amount of gain or loss outside that amount? And if you have too much accumulating, too much outside, then you need to take it back down. But it doesn't let you take the amount back down all at once. You have to take it back down a little at a time. And that amount, that little of the time, you can think of it as a straight line sort of amortization out of OCI. It's based on the average remaining service time of your current employees that are expected to get the benefits. So if it's 10 years, you take 1/10 of it out. If it's 20 years, 1/20 of it out. So here in the first one, in the bullet here, you have a loss. Then you're going to be crediting the OCI, or if you've already closed it into AOCI, credit AOCI and take it out to pension expense. If you have a gain, you are going to be taking it out of OCI, and it showed up as a credit in OCI, so you'd be debiting OCI, or if you've already closed to AOCI, and you are going to be crediting pension expense. So in the first case, you are running that loss, a little bit of the loss, 1/10, 1/20, whatever, through your income statement. In the second one, you are taking a little bit of that gain, that excess gain that you calculated based on 10% of your PBO or plan assets, whichever is higher. Take a little bit of that and let it show up in your income statement. That's the corridor method. This is an elaborate way of looking at it, since some of you really like numbers. Let's say in year one you have a $19,000 loss. Then the value of the PBO is 200,000, and the value of your plan assets is 180,000. Take the bigger of those two, 10%. The bigger one of those is a 200 times 10%. Again, don't look at PBO being a liability and plan assets being an asset, and PBO having a credit balance and plan asset having a debit. We're not concerned with debits and credits here. We're saying which one's bigger. And that's really their metric of when they think things are getting out of control in that AOCI, is to look at the value of PBO and plan assets, and they want everything to be in proportion to that. So 10% of 200,000 is 20,000, and their loss was 19. Again, I don't really want you to think of it as a debit or credit on the loss. Just look at the 19. Is the 19 a number that is less than 20? And it is less than 20, so we can keep it there. If you were go on into the second one, and year one, say, is the first year of our operation, so we had nothing in AOCI. If you had a 21 loss, then when you get to the second year, your AOCI has grown up to 40. And when you do your calculation, you get 10% of the bigger of PBO or plan assets, it's 26. So now you see that 40 is outside of 26. It's greater than 26. So now what you need to do is you need to take a part of the 14 out of OCI. So you can't keep as much in there as you would have normally done. Normally, we would have taken the whole 21 to OCI in year two, and we would have recorded it as a debit to OCI. They're saying your OCI is out of control. We should only have 26 in there, and if you take all of that, you're going to be at 40, and we don't want 40. We want you to limit that. Limit it back to 26. So, they don't want you to take it all out all at once. So in the last column, the conclusion says that you are going to take an additional amount to pension expense for this year, and the pension expense for this year is going to be $1,400. Now, is it going to be a debit? Is it going to be a credit? Well, we need to have 26,000 in there. That's the only amount we can have. So the easy way to look at this is to say, let's get that AOCI down to the maximum amount, and the maximum amount we could have in there is 26. Don't take all of that difference out. Take only part of it out. I'm not going to ask you to go on to year 3 because it gets quite confusing, and I will never ask you to calculate year 3. However, I think you need to be able to understand year 2. Now there's a little bit of extra thing we need to start talking about here. And this is the fact that when we talk about pension expense, that a part of pension expense is really compensation. And that part I'm talking about is service costs, because we are paying the employees in the future based on their service to us today. We are paying them in the future. We're creating that liability. We said it's a part of PBO, but it's because they're working for us. It's not because of an increase due to time value of money. It's because they've actually worked for us. If they work for us, shouldn't we be calling it compensation? And a recent change has been in GAAP to call this actually showing it separately as a part of compensation expense. And the last paragraph, pension expense is shown on the financial statement after income from operations, while service costs, so pension expense, the first one we're referring to here is pension expense less service costs. Say while service costs, that part of pension expense we've been calling pension expense, which are the costs of operating businesses, should be shown above as a part of income from operation, from the actual operations as an actual part of compensation. Okay, so a bit confusing. All we're saying is when you get that pension expense item, you go out and you're going to start your income statement and prepare your income statement. Pull out service cost and call it a part of your compensation costs. If you were to look at the detailed proxy statements, which detail the compensation for the executives, you would see this pension cost showing up in those schedules and this service cost showing up in the schedules then is a part of the compensation for the employee.